The $38 trillion time bomb. The United States now owes over $38 trillion, the largest debt in human history. That's more than the entire economies of China, Japan, and Germany combined. On paper, it sounds distant, numbers buried in Washington spreadsheets. But divide that debt across every American citizen, and it equals over $111,000 per person. Every newborn, every retiree, every worker already owes six figures before earning a dollar. And here's the real danger. This number isn't shrinking, it's accelerating. In 2000, the national debt was $5 trillion. By 2010, it hit $13 trillion. By 2020, $27 trillion. And today, $38 trillion and counting. That's nearly $1 trillion in new debt every 100 days. The question is not if this debt matters, it's when it breaks the system holding up the global economy. Because every empire in history, Rome, Britain, the Soviet Union, discovered the same truth. When the foundation of trust in money collapses, power collapses with it. In this documentary, we'll break down the $38 trillion question shaping our future, how America's debt became the foundation of global prosperity, why that same system is now cracking under its own weight, and what happens when the world's reserve currency begins to lose the world's trust. From Washington to Beijing, from Wall Street to Main Street, this is the story of debt, dominance, and the silent countdown to the next collapse. Let's analyze this problem in 6 phases. How America's debt grew to $38 trillion. The making of a $38 trillion problem. How the system driving this debt works. The debt machine explained. What happens as borrowing costs rise? The cost of money rises. How the world depends on US debt and the global fallout. The danger when confidence breaks. The point of no return. What history teaches us from past crises. The lessons of past resets. How America's debt grew to $38 trillion. The making of a $38 trillion problem. The birth of the debt machine. America wasn't always the world's biggest borrower. In 1945, after World War II, US debt stood at 119% of GDP, high but understandable after fighting a global war. Yet the post-war boom quickly shrank that ratio. Factories reopened, exports soared, and tax revenues surged. By 1974, debt had fallen to just 31% of GDP. Back then, debt was seen as temporary, a wartime necessity, not a permanent policy tool. But that changed in 1971. When President Richard Nixon ended the gold standard, the US dollar was no longer tied to gold. For the first time, the United States could create money without metal backing. Debt became limitless. It also became addictive. The age of deficits. In the 1980s, President Ronald Reagan cut taxes and increased military spending to challenge the Soviet Union. The national debt tripled in a decade. Economists called it Reaganomics. Supporters argued that lower taxes would fuel growth. Critics warned it would mortgage the nation's future. Both were right. Growth surged, so did debt. By the early 2000s, Washington had normalized deficits. Every administration borrowed more, regardless of ideology. After the 9/11 attacks, the US entered 2 long wars, Afghanistan and Iraq, largely financed through borrowing. At home, tax cuts continued, even as spending rose. Debt became not just an emergency tool, but a permanent feature of American policy. Then came 2008, the financial crisis, a turning point. When Wall Street collapsed in 2008, the government bailed out banks and auto manufacturers to prevent total meltdown. The Federal Reserve slashed interest rates to near zero and began a massive program called quantitative easing, printing new money to buy government bonds. It worked, for a while. Markets recovered. But something changed fundamentally. Debt was now the solution, not the problem. In less than a year, the US added $2 trillion to its national debt. The precedent was set. In every crisis, the response would be the same. Borrow, spend, stabilize. That playbook repeated in 2020, the pandemic explosion. When COVID-19 hit, Washington unleashed the largest fiscal stimulus in history, over $6 trillion in new spending. Direct checks, unemployment aid, business loans, vaccine programs, all financed by borrowing. The Federal Reserve printed money at an unprecedented pace. In 2020 alone, 40% of all US dollars in existence were created. Inflation was inevitable, and it came. From 2020 to 2022, prices rose at the fastest rate in 4 decades. Mortgage rates doubled. The cost of everything, from eggs to energy, soared. And yet the debt kept growing, because the government had crossed a psychological line. Spending no longer required restraint. The interest trap. Today, the interest on US debt is the third largest item in the federal budget, after Social Security and defense. In 2024, the government spent over $1 trillion just paying interest. That's more than it spends on the military. And as interest rates rise, that number grows automatically. Imagine owing money on a credit card and taking out new cards just to pay the interest on the old ones. That's how Washington now operates. It's sustainable only as long as lenders believe the US will always pay. But confidence isn't infinite, and when it breaks, the consequences reach far beyond American borders. Debt as power and as poison. Here's the paradox. US debt made America powerful. Treasury bonds became the world's safest asset. Foreign governments, corporations, and banks buy them to store wealth and back currencies. This exorbitant privilege allowed the US to print money the world actually wanted. But the same privilege also masks fragility, because when your currency is the global standard, you can postpone consequences until the day confidence erodes. Then everything unravels at once. As of 2025, China holds $775 billion in US treasuries. Japan holds $1.1 trillion. US banks and pension funds hold trillions more. If interest costs rise too high, or if foreign investors step back, the chain reaction begins. Bond prices fall, the dollar weakens, and global markets panic. That's why the 38 trillion figure isn't just an accounting problem. It has a systemic risk. It's the foundation of global finance itself. But understanding how America accumulated this $38 trillion is only half the story. The real question is, how does the system actually work? This is where the invisible engine behind the numbers comes into play, the debt machine itself. Let's reveal the mechanics that keep this machine running. How the system driving this debt works, the debt machine explained. Debt has become America's engine and its potential trigger for collapse. But to understand how the machine truly works, we need to open it up and see who's lending, what's being promised, and what happens when confidence starts to shake. Every empire has its engine. Rome had its legions, Britain had its navy, and America has its debt. At the core of the modern US economy lies a complex feedback loop, a system where money, bonds, and trust are woven so tightly together that if one thread snaps, the entire web trembles. How the machine works. When the US Treasury needs money, it doesn't print it directly. It issues bonds, essentially IOUs that promise to pay interest in the future. These bonds are auctioned to investors, banks, pension funds, foreign governments, even individuals. In return, the Treasury receives cash, money it can spend on everything from defense to Medicare. Those bonds then circulate globally, traded like currency themselves. Every time the US borrows, it creates what economists call a safe asset, a financial instrument so trusted that it anchors the world economy. Central banks in Europe, Asia, and the Middle East all hold US treasuries as reserves. Corporations use them as collateral. Financial markets measure all risk relative to them. In short, American debt isn't just America's problem, it's everyone's foundation. The Federal Reserve, the silent partner. Standing behind this system is the Federal Reserve, the world's most powerful central bank. When investors hesitate to buy treasuries, the Fed steps in. It purchases bonds with newly created dollars, expanding its balance sheet and injecting liquidity into the system. This process, known as monetary easing, keeps interest rates low and debt affordable. But it also creates a dangerous illusion that money is infinite and risk can be managed by policy alone. From 2008 to 2024, the Federal Reserve's balance sheet ballooned from under $1 trillion to over $8 trillion. That's not just accounting. It's the Fed quietly absorbing America's growing debt burden to prevent panic. Each rescue builds stability, But each rescue also builds dependency. Who lends to America and why it matters? Roughly 1/3 of all US government debt is held by foreign creditors. The largest are Japan and China, but nations like the UK, South Korea, and Saudi Arabia also hold significant portions. Why do they lend? Because US treasuries are liquid, stable, and backed by the world's reserve currency. They serve as global savings accounts, earning modest interest while ensuring security. But that relationship is built on confidence. If foreign lenders ever doubt America's ability or willingness to pay, they can simply stop buying, or worse, start selling. That would trigger a chain reaction. Bond yields spike, the dollar weakens, and US borrowing costs explode overnight. This is why debt isn't merely a financial figure, it's a geopolitical weapon. Who holds it controls leverage, the invisible currency of trust. At its heart, the US debt machine runs on an invisible fuel: trust. Trust that the US economy will keep growing. Trust that the government will honor its bonds. Trust that the dollar will remain the ultimate store of value. But history warns that trust is fragile. Once lost, it never fully returns. In the 1970s, a brief loss of confidence in the dollar caused inflation to spiral to 14% and gold to soar 700%. The US recovered then, but only through painful interest rate hikes and recession. Today, the scale is far larger, the system far more interconnected. If confidence erodes now, it is not just the dollar at risk. It is the architecture of global finance itself, the dollar's double-edged sword. The dollar's dominance is both America's greatest strength and its hidden weakness. Because every international trade, from oil to semiconductors, is priced in dollars, global demand for them remains enormous. That allows the US to borrow cheaply and run deficits without immediate punishment. Economist Valéry Giscard d'Estaing once called it America's exorbitant privilege. But privileges can become prisons. If nations start settling trade in other currencies, as China, Russia, and parts of the Middle East are now experimenting with, global demand for dollars will fall. That would mean fewer buyers for US bonds, higher interest rates at home, and a direct threat to the financial ecosystem built over 8 decades. Fragility beneath the stability. From the outside, the system looks unshakable. The dollar strong, Treasury markets deep, US institutions stable. But beneath that surface lies mathematical fragility. The more the US borrows, the more it must rely on new borrowing to sustain the old, a pyramid that only works while confidence holds. Economists call it a confidence spiral. As long as investors believe, the spiral lifts markets higher. Once they doubt, it reverses, and the fall is rapid. That's the danger of the $38 trillion machine. It's not built to stop, it's built to spin, until momentum itself becomes the risk. The US debt machine may seem eternal, but it's colliding with a force it cannot escape: rising interest rates. For the first time in a generation, money has a real cost again. In the next section, we'll explore how a single percentage point increase in rates can add hundreds of billions to America's annual interest bill, why even minor shifts in bond yields can destabilize global markets, and how the very tool that once sustained the empire could now be the spark that brings it down. The interest trap, when borrowing becomes the crisis. For decades, the United States enjoyed a simple truth: debt didn't matter because interest rates were near zero. From the early 1980s to 2020, borrowing costs steadily fell. Every new crisis, the dot-com crash, the Great Recession, the pandemic, was met with lower and lower rates. The system learned to survive not through discipline, but through cheap money. But that era is over. In 2022, inflation roared back to life. And for the first time in 40 years, the Federal Reserve was forced to raise rates, fast. That decision changed everything. The cost of money rises. In 2020, the US government could borrow for 10 years at less than 1%. By 2024, that same loan cost over 4.5%. It might sound small, just a few percentage points, but when your debt is $38 trillion, every point equals hundreds of billions of dollars. A 1% increase adds roughly $380 billion in annual interest payments. A 2% rise means nearly $760 billion. Combine that with new borrowing, and interest becomes the fastest-growing expense in the entire federal budget. In 2024, the United States spent over $1 trillion just on interest, more than on national defense. Within a few years, that number could exceed $1.5 trillion, rivaling Social Security itself. The math is simple, but the implications are devastating. The more the US borrows, the more it owes. The more it owes, the higher its interest bill. The higher the bill, the more it must borrow, creating a self-feeding spiral that even economic growth struggles to outrun. This is the interest trap, a loop with no political solution, only arithmetic consequences. Why the Federal Reserve is cornered. The Federal Reserve faces an impossible dilemma. If it keeps rates high to fight inflation, it risks bankrupting the government's budget through soaring interest costs. If it lowers rates to ease debt pressure, inflation could return, eroding confidence in the dollar. Either path weakens trust, and in a debt-based system, trust is the only collateral that truly matters. The Fed once had room to maneuver, now it's trapped between inflation and insolvency. That's why economists call this moment the policy doom loop. Every decision creates a new problem. Print money, you get inflation. Raise rates, you get default risk. Do nothing, you get stagnation. For an empire built on credit, that's an existential bind, the market's fragile faith. Global investors still buy US bonds, but with rising suspicion. In 2023, demand from foreign central banks fell to its lowest share in decades. Private funds and US households had to step in to absorb record Treasury issuance. That's not a sign of strength, it's a red flag. The US is now borrowing heavily from itself, printing money through the Fed, recycling capital through domestic funds, and calling it stability. It's like paying off one credit card with another, while the interest meter spins faster every month. Once foreign nations trusted US bonds because they symbolized safety. Now they buy them because they have no alternative, yet. When interest becomes the crisis. History shows that empires rarely collapse because they run out of power. They collapse because they run out of margin. In the 18th century, France spent half its tax revenue servicing debt, just before its monarchy fell. In the 1980s, Latin American nations defaulted under crushing interest rates. In the 1990s, Japan's lost decade began when its asset bubble burst and debt deflation trapped the economy for years. The US faces a similar pattern, but on a global scale. Each additional dollar of debt adds less growth and more drag. Each rate hike squeezes consumers, corporations, and the government simultaneously. Even small fluctuations ripple across the world. Mortgage costs rise, stock markets fall, currencies tremble. The system was designed for perpetual expansion, not expensive money. And now it's colliding with reality. The human cost of rising rates. Behind the numbers are real lives. Every time the Fed raises rates, mortgage payments climb, home ownership slips further out of reach. Credit card debt, now topping $1.3 trillion, grows harder to repay. Small businesses struggle to finance operations. State governments cut programs to manage higher borrowing costs. The middle class, once the backbone of American growth, is caught between inflation and interest, losing ground on both sides. And when the average American carries over $59,000 in personal debt, rising rates don't just affect Wall Street, they squeeze Main Street. The domino risk. In a tightly connected financial world, the US interest trap isn't isolated. Every global bank, pension fund, and insurance company holds US treasuries. If their value drops, even slightly, portfolios worldwide take losses. That forces selling, which drives yields higher, which triggers more losses, a cascade effect. This is how a domestic debt issue becomes a global liquidity crisis. The same mechanism that nearly froze the world economy in 2008, but on a scale far larger. Because today the system isn't just leveraged, it's interlinked. The US interest trap isn't the end of the story, it's the trigger. The next question is what happens when the rest of the world reacts. 3. The global fallout. How the world feeds on US debt. The $38 trillion debt crisis isn't confined to Washington. It is the backbone of global finance, the oxygen every other economy breathes. If the US debt machine stalls, The world doesn't merely slow, it suffocates. Every modern nation from Beijing to Berlin relies on US debt for stability, liquidity, and trade. And that dependence has quietly turned the American balance sheet into the world's greatest systemic risk, the dollar empire. Since 1944, the US dollar has sat at the center of the global financial system. It's the currency of trade, the unit of oil, and the standard for international settlement. About 88% of global trade is invoiced in dollars, even between countries that have nothing to do with the US. That dominance creates what economists call the dollar empire. Every central bank needs dollars to buy imports, repay debts, or stabilize their own currencies. And to hold dollars, they buy US Treasuries, effectively lending money back to Washington. In this way, America's debt becomes everyone else's savings. The US prints, the world purchases. It's a symbiotic cycle until confidence falters. China, the reluctant financier. For 2 decades, China has been America's second largest lender, holding roughly $775 billion in treasuries. This relationship is often described as mutual hostage economics. Beijing needs the US consumer, the world's biggest buyer. Washington needs China's saving, the world's biggest lender. But that balance is shifting. As tensions rise over trade, technology, and Taiwan, China has quietly reduced its US bond holdings. Instead, it is stockpiling gold and settling oil purchases in yuan through bilateral agreements with Saudi Arabia and Russia. This marks the early stage of de-dollarization, a slow erosion of the dollar's monopoly in global trade. It's not a crash, it's a drift, and drifts over time reshape power. If China accelerates this shift, the demand for US debt could weaken dramatically, raising America's borrowing costs and threatening the stability of the entire financial order. Japan, the loyal lender under strain. Japan, America's largest foreign creditor, holds over $1.1 trillion in US debt. For decades, this alliance was unquestioned. Japan's export economy thrived on a strong US market, and its trade surpluses were parked safely in treasuries. But now Japan faces a dilemma. As US interest rates rise, the value of those existing bonds falls. To defend its own currency, the yen, Japan has begun selling some treasuries to stabilize markets at home. If that trend grows, it could trigger a dangerous feedback loop. Foreign holders sell, US yields rise, prices fall, more selling. That's not speculation. That's a blueprint for global contagion. The petrodollar system cracks in the foundation. For half a century, oil has been priced in dollars, a deal forged between the US and Saudi Arabia in the 1970s. This petrodollar system ensures constant global demand for dollars and, by extension, US debt. Every barrel of oil sold generates new dollar flows back into treasury markets. That's what keeps borrowing costs low and liquidity abundant. But change is underway. Saudi Arabia has joined the BRICS alliance, alongside China, Russia, and India, all exploring non-dollar trade settlements. If even a fraction of global oil transactions move away from dollars, demand for treasuries will weaken, undermining one of the core pillars of American financial dominance. This isn't just economic, it's geopolitical, because whoever controls the world's reserve currency controls the tempo of global power. The domino network. Global finance is a web of interlocking promises. When one corner shakes, vibrations spread everywhere. If US bond yields surge, it raises borrowing costs for every other country. Emerging markets, from Brazil to Turkey to Pakistan, often borrow in dollars. Higher yields mean weaker local currencies, capital flight, and balance of payment crises. That is why a policy decision in Washington can spark a currency crisis in Argentina or a stock market crash in Asia. The world doesn't just watch the Fed, it lives by it. When US debt becomes volatile, global credit freezes. Banks pull back, trade slows, investment halts. That's the moment when a domestic fiscal issue becomes an international depression, the fragile consensus. For decades, nations accepted the US-led system because it offered one thing above all: stability. But after multiple crises, 2008, 2020, and now surging interest costs, that stability looks increasingly fragile. countries are diversifying. Russia and China are building parallel payment systems outside SWIFT. BRICS nations are exploring a joint currency. Central banks are buying gold at the fastest pace in 50 years. The world isn't abandoning the dollar yet, but it's preparing for the day it might have to. Every financial empire falls not when it runs out of credit, but when it runs out of trust. The $38 trillion debt machine still turns. The dollar still dominates and investors still believe. But belief is not infinite. In the next section, the point of no return, we'll explore what happens when that faith begins to fracture, how markets react, how ordinary Americans feel the impact, and how the collapse of confidence could transform a financial crisis into a civilizational turning point. 4. The point of no return, when confidence breaks. Every financial system rests on a single invisible pillar: trust. The belief that tomorrow's dollar will still have value, that governments will repay their debts, that the system will hold. But history shows that once trust breaks, collapse isn't gradual. It's sudden. That's the moment when numbers on a screen turn into panic in the streets, the fragile illusion of control. For decades, US policymakers reassured the world that America's debt was safe, risk-free. Even as the national debt ballooned from $5 trillion in 2000 to $38 trillion today, markets believed the US could always pay, always print, always prevail. But cracks are showing. In 2023, for the first time in history, the US had to spend over $1 trillion just on interest payments, more than it spends on defense. That number is rising faster than any other part of the federal budget. To cover it, Washington must borrow even more, issuing new debt just to pay interest on old debt. It's the financial equivalent of paying one credit card with another. At some point, confidence gives way to doubt. What if the US can't roll over its debt? What if investors demand higher returns? What if the world starts saying no? The yield shock. Here's where theory turns into impact. When investors lose confidence, they demand higher yields, meaning the government must offer more interest to attract buyers. That's already happening. 10-year Treasury yields have climbed to their highest level in 2 decades. Every 1% rise in average interest rates adds hundreds of billions in new annual costs to the US government. It is a feedback loop. Higher debt, higher rates, higher interest, even higher debt. Eventually, markets stop seeing treasuries as risk-free and start seeing them as risk-priced. That's the tipping point from stability to spiral. The banking chain reaction. The danger doesn't stay in Washington. It spreads through the banking system. Banks worldwide hold trillions of dollars in US bonds as their safe assets. But when bond prices fall due to rising yields, those safe assets lose value. We saw a preview in 2023 when Silicon Valley Bank collapsed. Its downfall wasn't from bad loans, it was from Treasury losses. Multiply that across hundreds of financial institutions, and the risk becomes systemic. A sudden surge in yields could trigger a wave of mark-to-market losses, eroding capital buffers and freezing lending. What began as a fiscal issue could metastasize into a full-blown financial crisis, the social unraveling. The consequences don't end on Wall Street, they hit Main Street hardest. If Treasury yields surge, mortgage rates, car loans, and credit cards all follow. The average American, already burdened with over $111,000 in personal debt, feels the squeeze. Small businesses face credit crunches, layoffs rise. The government, desperate to respond, may unleash another round of printing, igniting inflation all over again. Confidence breaks in stages. First in the bond market, then in banks, then in the currency itself. And when citizens start doubting the dollar, society enters its most dangerous phase, the loss of faith in the very system holding it together. The political spiral. Economic crises rarely stay economic. They become political earthquakes. Polarization deepens. Populist movements rise, some calling for debt forgiveness, others for austerity, others for radical reform. The government faces impossible choices: raise taxes and anger voters, or print money and destroy savings. In history, this phase has always been the turning point. Rome debasing its silver denarius until it lost all value. Weimar Germany where inflation wiped out the middle class and paved the road to extremism. The Soviet Union, whose financial strain from military overreach cracked its political core. Empires rarely fall because they can't pay their debts. They fall because their people stop believing those debts will ever be repaid, the moment of recognition. Every crisis has a moment of recognition when the narrative breaks. It doesn't arrive with a speech or a headline. It begins quietly, a failed auction, a sudden market plunge, a central bank intervention that doesn't work. And then, panic accelerates faster than any policy can respond. Foreign investors pull out, the dollar weakens, Treasury yields spike, global markets tumble, and suddenly, the very asset once considered the safest in the world becomes the source of global instability. This isn't a doomsday prophecy, it's the natural consequence of ignoring arithmetic. Debt grows geometrically, confidence collapses exponentially, and somewhere in between lies the point of no return. The inevitable reset, a new financial order. So what happens after the breaking point? History tells us that every debt crisis, no matter how vast, ends the same way, with a reset. Old systems collapse, new systems rise, currencies devalue, wealth redistributes, power realigns. In the final section, the inevitable reset, we'll explore what a post-dollar world might look like, how nations could rebuild trust, what new currency systems may emerge, and why, as the $38 trillion time bomb ticks louder, the end might also mark a new beginning. The inevitable reset, a new financial order. When financial systems reach their breaking point, they don't just fail, they transform. Debt doesn't vanish. It's restructured. Currencies don't disappear, they're redefined, and power doesn't end. It shifts. Throughout history, every great financial reset has followed the same rhythm: collapse, chaos, creation. The question isn't whether America's $38 trillion debt will trigger a reset, but what kind of world will rise from it. The lessons of past resets. History offers a roadmap. Each empire that rose to financial dominance eventually faced its reckoning. Britain, after World War II, watched the pound lose its global reserve status to the dollar, a slow erosion of power that took a single generation. France, after decades of fiscal excess, reset its currency 6 times in the 20th century. Rome, after debasing its currency beyond recognition, saw its economy fragment and its empire splinter. Every reset followed a moment of unbearable strain, when printing money no longer restored confidence, and promises outgrew the nation's ability to deliver. America's situation today mirrors those past turning points, except for one critical difference. The entire world is tied to the US dollar, the dollar's fragile throne. For nearly 80 years, the US dollar has ruled global finance. Oil, trade, commodities, and debt, all priced in dollars. This petrodollar system gave America unparalleled influence, the ability to borrow cheaply, sanction enemies, and project economic power without firing a shot. But dominance breeds dependence, and dependence breeds fragility. In recent years, cracks have widened. China and Russia now settle energy trades in yuan. BRICS nations have openly discussed creating a new trade currency. Central banks worldwide are reducing dollar holdings and buying gold at record levels. The world isn't abandoning the dollar overnight. It's hedging against its fall. The digital reset. Every global reset brings a technological shift, and this one will be no different. Central banks are quietly building a new foundation. CBDCs, central bank digital currencies. Unlike cryptocurrencies, these aren't decentralized or private. They're programmable, traceable, and controlled by governments. A CBDC system could do what paper money cannot: enforce spending limits or expiration dates, control capital flows in real time, replace cash entirely with digital credits. In a post-debt crisis world, this system would offer control disguised as stability, a tool to rebuild trust while consolidating unprecedented power over money itself. The Federal Reserve, European Central Bank, and People's Bank of China are already in late-stage pilots. The race isn't T just for stability, it's S for monetary dominance in the digital era, the gold and commodity revival. But not everyone trusts a digital future. As faith in fiat weakens, nations are turning back to something ancient, hard assets. Gold reserves are rising at the fastest rate in half a century. China, Russia, and even developing nations are accumulating bullion quietly, preparing for a world where digital currencies are anchored to real commodities. A future BRICS currency, for instance, could be partially gold-backed, giving it instant credibility against the debt-saturated dollar. It wouldn't replace the dollar immediately, but it would offer an alternative, the first serious challenge to US monetary dominance since 1945, the multipolar era. The next financial order may not have a single ruler. Instead, it could resemble a multipolar system, where different regions use different anchors of trust. The US continues using the dollar domestically, backed by its markets and technology. China promotes the yuan for Asian trade. Europe stabilizes around a digital euro. Emerging nations trade via gold or commodity-backed currencies. This wouldn't be chaos, it would be transition. A gradual redistribution of monetary power, mirroring the redistribution of geopolitical influence already underway. And in this world, America's greatest challenge won't be the size of its debt, but the shrinking of its privilege, the opportunity in collapse. Every reset is both destruction and rebirth. After Rome fell, Europe eventually gave rise to modern nation-states. After Britain's financial empire faded, America's innovation empire emerged. The next reset could do the same, forcing societies to rethink what value truly means. Will wealth still be measured in dollars, or in data, resources, and resilience? Will nations compete through military might, or through control of energy, minerals, and AI infrastructure? And will individuals regain financial independence through decentralized systems, or lose it entirely under programmable currencies? The answers will define the 21st century, the quiet countdown. The $38 trillion time bomb isn't just a story about debt, it's a story about trust. Every promise, every bond, every dollar is built on it. And once that trust begins to fade, history accelerates. The reset won't arrive with an announcement. It will unfold silently, in policy meetings, in market shifts, in the quiet decisions of billions of people choosing where to put their faith. But one thing is certain, the next era of global finance will not look like the last. Because behind every chart, every budget, every interest rate, there's a deeper law of history. No empire can outrun its debt forever. The United States taught the world how to build a financial empire on credit. Now it may teach the world what happens when that credit runs out. The story of debt is the story of power, how it's built, how it's used, and how it ends. Every civilization believes it's different. Every empire believes it can manage what others couldn't, but arithmetic always wins. And as the US crosses the threshold of $38 trillion, the line between control and collapse grows thinner by the day. Because in the end, the greatest risk isn't that the system will fail, it's that we'll pretend it never could. Enjoyed the deep dive? Like the video, subscribe, and turn on notifications. We bring you the full picture every time.